Hello everyone. Your textbook does not have a guided example on how to calculate the interest and principal on an installment term note, so I'm just going to do a video for you in case you need it. We did go over this problem in class on Wednesday, but in case you weren't there or in case you do want a video refresher, you've got this quick video to refer to. This information, of course, is always available in Moodle, also under the lecture notes if you want to read through it. So this first problem is on page 508 of your textbook. It's exercise E10-10B. And our problem reads, on December 31st, 2017, James Inc. borrowed $500,000 on an 8% 10-year mortgage note payable. The note is to be repaid in equal quarterly installments of $18,278 beginning March 31st of 2018. We're going to do journal entries to record the issuance of the mortgage note payable and then to record the payment of the first installment and the payment of the second installment. So on an installment loan, what we're going to need to remember is this isn't paid back at the very end of the term. We're actually making payments throughout the life of the loan. So every time we make a payment, that's going to reduce this principal balance. So we're going to need to recalculate the breakdown between principal and interest of the payment every time we make a payment. So this principal amount is going to continue to be reduced every single time we make a payment. The other thing we want to look at before we start is that these payments are being made in quarterly installments. So he's going to make 4 payments throughout the year. Quarter is 4 times a year, and each quarter is 3 months long. So that's going to be the length of each payment. That's going to be your time factor in the payment, 3 months. The first entry is to record the issuance of the mortgage note payable. And we assume here that he gets cash from a bank, and he's going to take that cash and buy a building, but in the interim he needs to record that he's received the cash, so he's going to debit cash, and he's going to credit mortgage note payable. A mortgage note payable is a liability, something he has to pay back, and you increase a liability by posting a credit. Now we come down to the first month. To record the payment, what we're going to need is break it down into the part of it that's interest and the part of it that's going to principal. So how we do that is we take our principal balance, and at the very beginning of the loan it's $500,000 because this is his first payment, so he's still got the full balance owing. We're going to multiply by the interest rate, 8%, and that was given to us in the problem. And then remember, each payment covers 3 months. Quarterly payments made 4 times a year. Each payment covers 3 months. So our numerator is going to be 3 and our denominator is going to be 12 because we're calculating this in months. So if we do the math on this figure here, that's going to give us an interest amount of $10,000. This is our interest calculation. So if our total payment is $18,278 and our interest is $10,000, that means the principal amount is $8,278. So you record this by debiting interest expense for $10,000, debiting mortgage note payable for $8,278, and crediting cash for $18,278. This shows that we're reducing our cash by paying our mortgage. This shows that we've incurred an expense of $10,000 for the 3 months that we had the loan. And our mortgage note payable, this is reducing our balance of $500,000. We started with a credit of $500,000, and now we've got a debit against it of $8,278. So this is reducing our principal that's owing. And that comes into play when we do this, when we record the second payment. If you look down here, this is our principal of $500,000. If we subtract out the $8,278, the amount of principal we paid in our first payment, we now owe a principal of $491,722. So that's the number that we're actually going to use to calculate the interest on for our next payment. So we take that new principal balance of $491,722, multiply by, again, our 8%. That's the interest rate we were given in the problem. And then every single one of these payments, again, covers 3 months. So our time factor here is going to be 3 over 12. So that means our interest amount for the second payment is $9,834. And you'll notice that the interest should be going down every single time you make a payment, and the principal portion of the payment should be going up every single time. So if we do the math again on that, $18,278 is our total payment. Subtract out our interest of $9,834. That means our principal amount is going to be $8,444. So we're going to record this as an interest expense of $9,834 from this calculation up here. Our mortgage note payable, we're going to again reduce, we're going to do a debit to again reduce that balance of $8,444. And then as always, our cash is going to be a credit of $18,278 to show that we've made a payment. So this is the first problem we worked through. The second one that we discussed is a little bit different in the fact that they're making semi-annual payments. So if you're making a semi-annual payment, that means you're making 2 payments a year. So each payment covers 6 months. So this one will be calculated the same way the other one was. However, if you get down here to your time factor, you see I've got 6 divided by 12 as my time factor. Or you could just use 1/2 because the payment covers 6 months, every single payment. So otherwise it's done the same way. So hopefully that'll help you if you need a refresher for the homework. If you have any questions, just let me know.